Hi, I'm Mark Anderson, a mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I work with people around the country on their mortgage transactions, whether it's for a new purchase or a refinance. If you would like me to take a look at your mortgage options, please don't hesitate. Call or text me at the number below anytime. What you'll find working with me, I am not the high-pressure sales guy. I have no interest in pushing anybody into a mortgage or a product that doesn't make sense for them. We can just have an honest, open, transparent conversation, evaluate your options. If we can do business together, great. But if not, I'm happy to have the conversation. For today's mortgage rate update video, I am going to tell the story of this year so far, told through the lens of the year-long mortgage bond price graph. Now, a primer for anybody that maybe hasn't watched my videos in the past. There is a fundamental relationship that you need to understand between the bond market and mortgage interest rates. So what drives mortgage interest rates? Generally speaking, it is not the government. I'm going to put an asterisk on that and come back to it. It's not the government. The Federal Reserve does not set the mortgage rates. When you hear about the Fed dropping the prime rate, it has basically no relationship with mortgage rates whatsoever. There's times where they drop their federal funds rates and mortgage rates go up, and there's times where the exact opposite happens. So they do not control mortgage rates directly. Again, we're going to come back to that asterisk that I've got to put on that statement here in a moment. Generally speaking, what drives the mortgage rate that you are going to get as a consumer is the price of mortgage bonds. Mortgage bonds, as they go up in price, cause mortgage rates to go down. And the opposite is true as well. If mortgage bond prices fall, your mortgage rates will go up. So that's fundamentally what you need to know when looking at this bond price chart. If we go back to a year ago, we've got a bond price, let's see here, about this same time last year, we've got a bond price of 99.08. Now don't worry about that number too much. What's interesting is the comparison. Bond prices today are at 104.4. And what I can tell you, mortgage rates at this time last year, I'm going to guess on a standard 30-year fixed transaction, you're probably looking at somewhere around 4.5%. Today, you're almost certainly going to have a 2 in front of it. Now, quick legal small print verbiage I've got to throw out there. I can't quote specific rates on these videos. Mortgage rate quotes are based on all kinds of criteria, and so I really can't, from a practical and legal standpoint, quote specific rates. But generally speaking, 4.5 over here, and you've probably got a 2 in front of it if you're looking at rates today. Now, what is really interesting with this graph is what started to happen right around here. The mortgage bond prices started to go up. Well, you might ask, why did the mortgage bond prices start to go up in late January through February? Well, what was happening at the time is we heard about this virus that came from the Wuhan province in China. There was some anxiety about that in February. And that anxiety was causing the stock market to have kind of a rough go of it. Now, generally speaking, this relationship is not always the case, but when the stock market goes down, bond prices generally go up. And what's really happening there on a really macro level is all of the money, all of the stuff, all of the institutional investors that are putting their money into the stock market, when times look uncertain, when things are potentially going to get bad, they want to put their money into a safer investment than stocks. And bonds have always represented a very safe haven for money. The returns are nowhere near what you can get in the stock market generally. So it's seen as a safer return, albeit not as much of a strong return on your money. So generally what was happening here is the anxiety about this virus was causing the stock market value to go down, and it was shoving more money into bonds. And as more money went into the bond market, you see these bond prices started to pick up. Now, at around this time, say late February, I was happy with what I was seeing on my rate sheet. I had started to reach out to some of my past clients about refinance opportunities. I did not predict what happened in March. Let's see if I can find the exact day here. I'm fairly certain I remember this exact day, Monday, March the 2nd. That is the day that my life really, really changed. In terms of a work-life balance, That really changed starting here on Monday, March the 2nd. It was around this time that the bond prices spiked, and this caused mortgage interest rates to drop like really, really dramatically. If this is the morning I'm remembering, before I even got into the office, I think I had 7 voicemails and some texts from past clients that were pretty market savvy people that were paying attention to what was going on, and they wanted to know whether or not it made sense to do a refi. Pretty much from then until now, it has been a very, very good time to refinance. These rates are truly lower than we have ever seen in history. Now, the story in March is very interesting because this big spike in bond prices that caused the mortgage interest rates to fall, it was not sustained. So at the beginning of the month here, you see we're very, very high, and then there's a big drop here on the 12th. Now, what happened here is my rate sheets, I think my rates went up over a full percentage point. I think I was quoting people at around this time. I said, well, maybe it'll come back, but I think you missed the boat because all of a sudden the rate probably had a 4 in front of it as opposed to a 2. It was that dramatic, and it was overnight. Now, the bond market jumped up again here. All of a sudden, we were back. These were crazy, crazy, volatile times for sure. I would have phone conversations with people in the morning, talk about interest rates. They'd think about it. They'd call me back in the afternoon, and I have to say, that rate's gone. And it was a very, very trying time. It was very, very difficult to get something locked in. And nobody knew what was going to happen. Nobody knew whether or not these low rates were going to stick around. There were a lot of people that thought the rates were going to get significantly better. Now, over here, we saw another big drop in the mortgage bond prices. And again, mortgage interest rates very, very quickly switched, over a full percentage point from what was available maybe the previous day. Now, what was going on behind the scenes at this point is something that I've never seen. I've seen refinance booms in the past, and actually usually the bond price graph usually looks something like this. There's some event that causes the bond prices to shoot up. There's a very limited window of opportunity for people to lock in, and then it goes away and you're back to normal interest rates. So in some ways it was a pattern that I'd seen before, that I'd grown accustomed to, and I kind of thought, well, maybe this ship has sailed. But what happened here, and the reason that the bond prices collapsed so quickly, is that this safe haven that is the bond market was seen by a lot of the big institutional investors, some of which were very leveraged. Probably should share that for another video. You saw big bond investors leave the bond market, which is something that's really, really not typical. There was so much money that left the market, and there was such a dramatic shift in the bond prices that the Federal Reserve basically turned on the money machine, and they got directly involved in the mortgage bond market to stabilize this market. So as the memes say, the Fed goes burr, and they have been operating that plan pretty much ever since. Now, what we saw at this point here, the Fed's actions to start buying mortgage bonds, they basically jumped in the place of the bond investors that normally would have been there in the private market. They jumped in, they started buying mortgage bonds, very, very huge amounts of mortgage bonds. It's numbers that you can't, you hear billion, you hear 40 billion, you hear 60 billion. It's really difficult to place what that number even means in terms of scale. What I can tell you, since they started this program to now, this very, very sustained period of incredibly low interest rates has involved about, I think it's over $1 trillion of investment from the Federal Reserve to basically prop up this market and keep it stable. Now, I do not think that the Fed's primary goal was to give people an opportunity to refinance. There's a lot of other things behind the scenes that I'll maybe share for another video that gets a little bit more technical. But suffice to say, their involvement in the bond market essentially stabilized the bond market and has put us in a position where, whether you're looking end of March until today, you're seeing rates that I think really have only shifted about maybe 0.375 to 0.5. So yeah, there's a lot of peaks and valleys here, but the actual change in rates, the difference in rates, they're low all through this period of time. Now, there were certainly some times where the mortgage bonds dipped and we saw rate increases. There were some people that maybe locked in at the wrong time. There were people that locked in at more favorable times. But generally speaking, we have seen an incredibly stable, low interest rate environment from this point on. I think it is useful to have this context to understand what I'm going to recommend in terms of looking at your options going forward. If you want to know what the mortgage rates are going to do going forward, there are really two key things that matter. One, I'm going to get back to the asterisk comment I mentioned before, that the Federal Reserve does not control mortgage interest rates. This is true. Directly speaking, the Federal Reserve is not controlling the mortgage rates. Their bond buying activity has stimulated the market in such a way that it has led to an outcome that includes very, very low interest rates. But it is not them turning the dials here to keep rates low specifically. They're not directly controlling it. Given how important their involvement in the bond market is, the one thing you want to look out for out of these two key things to look at is the Federal Reserve. If they stop or slow down the bond purchase program, that is going to have a dramatic impact on mortgage rates. If you go back to here, before the Federal Reserve was buying bonds, you saw this huge volatility. I mean, these swings are enormous and led to, basically over a full percentage point difference in mortgage rates on a day-to-day basis, depending on what was going on in this bond market. You can expect a level of volatility, I think, that would be very similar to this cycle here if the Fed exits this program and if they stop injecting so much money into the mortgage bond market. The other thing to look for, which is probably tied to what the Federal Reserve is going to be up to, is really anything about COVID. The general element here is if there's good news about COVID, recently we had some news about a vaccine, that actually spooked the bond market. Bond prices went down that day. Mortgage rates went up like a hair. It didn't make a huge difference. But good news about COVID and potential recovery, a vaccine, that caused mortgage interest rates to get a little bit worse. Conversely, bad news about COVID. Let's say that there's something that comes out with one of these vaccines that it's nowhere near as effective as they say it is. That type of news would probably lead to mortgage bond prices going up and would probably lead to a little bit more favorable interest rates. Now, do I think that there is a chance that mortgage rates are going to go down further? I think that's incredibly, incredibly unlikely. Now, I will happily eat my words if I'm wrong, but I don't see it. I don't see anything from the fundamentals to suggest that we're going to see lower rates than what we're seeing right now. Now, day to day, there's always going to be some fluctuations. You could have a day where you're 0.125 better than the previous day, maybe a quarter point better than the previous day. But in terms of a big shift like what we saw when these rates first dropped, I just don't see it. The Federal Reserve is already contributing like a truly insane amount of money to prop up this market. Even if there's some bad news about COVID, which again would be bad for the stock market, which would push more money into bonds, I just don't see it moving the needle. So I don't see lower rates in the horizon. I see generally the case for much higher rates to be equally as unlikely. If the Federal Reserve completely exits the space, that could spell a pretty swift, abrupt end to the low rate cycle that we happen to be in right now. But I don't think, the Fed has gone to great lengths to make it very, very clear that whatever they do, stability is the goal. And to the extent that they are able, which maybe we could get into some cases where they are no longer able to control the bond market in the way that they are. But to the extent that they're able, they're going to keep things stable. And I think the Federal Reserve has made it very clear that they're going to do what they can do to keep things stable. And stable in this case means low interest rates. If there is a move away from the bond buying program, it's very likely that they're going to do it slowly. And as such, any changes that you're going to see in mortgage rates are going to happen equally as slowly. So probabilistically, 6 months, 12 months, I think we're going to see rates around where they're at right now. I don't think there is a big pressing reason to lock in if you're on the fence right now. I don't think that there is a golden opportunity window that's set to close in the next month or 2 months. Certainly if you're looking to buy a home, I wouldn't rush into a property that's not the right one for you just because you want to make sure to lock in these low rates. I don't see that case for urgency. So long story short, it's been a really, really crazy year. Personally, I've been very lucky. It's been a very, very good year for me and my business. It's a lot of long hours. I'm here in the office today at 10:30 at night shooting this video after a full day here, knocking out my responsibilities to the best of my ability. But those, long hours is one thing. I feel terrible for the many, many Americans that are either out of work completely or have had their income reduced seriously, are facing problems making the mortgage payment. One thing I really hope to see is I hope to see some sort of relief that benefits average folks out there that have been negatively impacted by everything that's gone on. It's at the risk of sounding a little negative. What's been good for me and my business with the Fed pumping over $1 trillion into this bond market that's kept the rates really low, as good as that is for me, I know there are a lot of people out there that are not doing well right now. And I hope that there's some good news for everyone soon. So along those lines, one thing, I'm going to call this a soft prediction. There are a lot of people that have not been able to benefit from the low rates. There are a lot of people that a low rate would be great, but the primary concern is making the payments at all. It is my hope, and I guess my somewhat optimistic prediction, that there are going to be some refinance programs that start coming online, I'd say hopefully early 2021. Programs that are actually geared toward folks that either missed mortgage payments due to a job loss or loss of income due to COVID. I think there is I actually do think there's a strong chance that there could be some relief in the form of some special programs. There's precedent for this. There was the HARP program in the past, which allowed people to refinance after the collapse in prices around the country due to the financial crisis in the kind of 2008 era. I think with that precedent, there's certainly going to be a lot of need. There are so many people that have not been able to take advantage of the low rates and could really use the help. So that's one thing I'm going to be looking for. I'm really looking forward to the day where I can give you some good news on that. But I do really hope that something is coming in terms of special programs there. But we'll keep an eye on things. I'm going to continue to do these videos to keep people aware of what's going on in the market, what's impacting rates, generally where they are, etc. I really appreciate you watching the video. I know this is a long one. Please do like the video, subscribe to the channel, and comment. Call me, text me anytime. I look forward to hearing from you. Thanks very much for watching.